Drop it.
Hello and welcome to Be Real, the Maryland real estate podcast. I'm Michael Becker of Sierra Pacific Mortgage, and as always, I'm joined by
Brad Cox with the Vesta Group of Long & Foster. Hey, Michael, how you doing?
Doing great. It's an ugly Saturday afternoon in here, but there's football on later on, so I'm a little excited about that.
Awesome.
This is a real estate podcast. We're going to talk a little bit about mortgages and real estate. Brad, since this is our second show, why don't we take a few seconds and tell the listeners how we're going to break down the show?
That sounds great. So our first segment is going to be called The Rundown, and that's when we'll talk about mortgages and where interest rates are, and Michael's going to pull out his crystal ball and make a prediction for us.
Yes.
And then we'll go over some of the real estate market metrics. And then we'll get into the next segment, which we're calling the scoop, and that's the main
What's
topic.
the scoop?
So So this scoop is going to be about first-time home buyers, their challenges and some solutions.
It's a big topic, folks. You're going to want to listen to what we have to say.
Absolutely. And then once we're finished with the scoop, then we move into a segment that we're calling the Unreal.
Unreal.
It's unreal.
It's so hard to believe.
Exactly. And it can be anything from what we find silly or funny or just astounding, crazy.
Or I can't believe they did that, or I can't believe they said that, or I can't believe that number.
Absolutely.
Something like that. So it's going to be the Unreal. Wow.
Yes. And then we will, the last segment will be what we call the Spotlight, because one of our missions here is also we want to help promote local businesses.
Sure.
So we're going to talk about a local business, give them a little bit of love, and let you know one that we like, and suggest that you go check it out.
Sounds like a great plan, Brad. So let's start with the rundown and talk a little bit about mortgage activity this week. I'm going to start with interest rates because when I get a call, that's what's on the top of people's minds. I got an email
Especially
this morning
today
from a previous client asking about rates. I giggled when he told me what his rate was, and I was honest and told him it didn't make sense to do anything at this point.
Right.
But we can have a conversation, and rates always change. So, and it's always good to have previous client reach out to you. But for the week, rates dropped. This is according to the Mortgage Bankers Association. There's lots of different overall rates. Now, one thing I need to say, and we're going to go into this a little bit later, is that every person's individual circumstance, from the loan-to-value to the debt-to-income ratio to credit score to the type of loan they get, whether it's conventional, government loan, a non-government loan, a non-QM loan. There's lots of different loans. There isn't one interest rate out there. A lot of times people will call you and say, what's your interest rate? So I like the Mortgage Bankers Association rate. It seems to be very accurate data. It's more timely than, say, Fannie Mae's primary market survey rate. Although I said Fannie Mae, it's Freddie Mac's survey. That tends to be a little delayed or slow to adjust to what the market's doing. So Mortgage Bankers Association is a good one. And they said that the rates had dropped this week, from 6.09 to 6.08. At the end of last week, rates were at 4-month lows. Yeah. They slightly improved this week, and that was to Wednesday. Now, if you want the most timely data, by the end of the week on Friday, we had a little bit of sell-off in the bond market, and rates worsened. But the drop in rate was also accompanied by a slight drop in points people are paying. In today's market, the way it's working, and most people, depending on their situation, do pay a small amount of points. It was 0.66 the previous week. It's now 0.4 points. 1 point is 1% of the loan amount.
Right.
So it often makes sense to pay a little bit of points to drop your rate a good bit. Again, when you're dealing with a mortgage originator, you want to have that conversation. How much does it cost in relation to the monthly savings, and what's the break-even period?
And sometimes it makes sense, and then sometimes it doesn't.
Right.
Like what we're going to talk about a little bit later in the rundown.
You keep teasing about what happened in the news. People will be interested.
Yes.
Now, as far as mortgage activity is concerned, here's the good news. Loan application overall for this week increased 27.9% on a seasonally adjusted basis.
People saw the drop in rates and thought, maybe it's time.
Refinance index rose 34%.
Wow, outstanding.
The purchase index is up 25%.
That's also
you're
good.
grinning and laughing because I shared this information with you before the show.
Yes.
But that all sounds great and all, but we fell off a cliff to lead in this. The important thing to remember, folks, is the refinance activity. Even though it's up 34% week over week, it's still down 80% year over year.
It's up from the chasm.
You can barely see it if you look at a yearly chart of how much it's ticked up.
Right.
And the purchase index, now that it's gone, it is better. It is still down from 35% year over year,
Sure.
which, if you think about it, it's pretty good considering this time last year in January there were still good rates. They were still doing rates in the threes.
Yeah.
In the low to mid threes, probably in early to mid January last year. Now they're almost double and only see a 35% drop. It's good, and I think the reason we saw an uptick in applications this week is that, as I said at the beginning of the show when I was talking about rates, we're at 4-month lows or thereabout.
Yeah.
They're the lowest they've been since early mid-September, which is a pretty good thing. They're heading in the right direction. Now,
well, it's just like the real estate market. In order to really get a good comparison against a normal market, you almost have to go back to something like 2019 to get a real flavor, because 2021, 2020,
yeah, they were
crazy.
Speaking
crazy
of our unreal segment, those were unreal years.
Yeah.
Not going to see. It's unlikely to see anything like that again for a while. I don't
hope
want to say
not.
ever.
Well,
Because you never say never. But anyway, it's good news that mortgage applications had increased week over week. Now, looking forward, one of the things I do for bankrate.com is give my guess as to where mortgage rates are going. And we're in a period where there's not a lot of economic activity that can move mortgage rates, and we're a ways off from the next Federal Reserve meeting. So there's going to be second-tier economic reports that are going to maybe move markets one way or another. But really, this week, the only thing that really moved markets in a substantial way was news from the Bank of Japan. And they basically were more dovish than the markets were considered. Dovish means interest rate friendly. Hawkish means interest rate negative, folks.
Right.
They decided not to change their yield curve control, which meant they've been pegging their 10-year Treasury at no higher than 0.5%. The markets thought they might let that go up a little bit. But anyway, we saw a big rally overnight and a nice rally on Wednesday. They sold off. Bonds sold off a little bit into the week. Maybe it was profit taken. Maybe the bond traders were looking to next week because there's a big supply of bonds going on. So there's big Treasury sales next week. That can negatively impact rates. Anyway, long story short, with a lack of market mover reports, and we're days away from Federal Reserve commenting, I kind of punted and said rates would stay flat. I didn't see anything move in markets. So if I was somebody advising as to whether to lock or not, if rates had gone up for 2 days in a row, I would say maybe we'll float today, see if we get a rally. If it had been 2 days of rallies like it was Tuesday and Wednesday of this week, I would probably have locked. So that's kind of how it's a feel thing. It's not an exact science, but when it comes to knowing where interest rates are going in the coming week, that's the kind of how I do that. So good news in the mortgage application segment of our show, and good news on interest rates. Why don't you tell us a little bit about some of the Baltimore Metro stats when it comes to real estate, Brad?
Sure. So over the last 7 days, because we want to try to keep this weekly, right? Very tight time frame.
You want to have timely information out there.
Yeah, absolutely. So 364 new listings came on the market, but what was interesting, almost double that. 679 were pending, and 395 sold. So take a look at that number. And then 271 off the market, right, for whatever reason, whether it was withdrawn or expired or temporarily taken off for whatever reason. The number that went off the market, whether it was for pending or sold, or far surpassed the number that came on, right? And
that kind of goes in line with the mortgage application numbers that I gave up. It seems the drop in rates has kind of increased activity out there.
Absolutely, right? So, but the challenge is still that inventory, right? When we don't see new listings coming on at a rate that's keeping up with the demand.
Could that be a seasonal thing? I mean, you don't think of January as a
January's
month that a lot
not
of
usually.
People are gonna,
yeah.
I mean, they're still putting away their Christmas decorations at the beginning of the month.
Right.
A lot of people don't necessarily want to list their house in January.
And it is low, but what we don't see typically is the difference between the two as pronounced as it is. So it just continues to be an issue with inventory challenges. So the days on the market were up from where we were. If you look at the average, it was about almost 40. The median's 21 days on the market. We had a volume of 136 million and change for the last 7 days. So overall volume is down too. What was another thing, though, that was really interesting was how many people were getting seller help. Now, let me ask you, Michael, were people getting seller help last year?
No, I'm laughing because you want a surefire way to not have your offer accepted, request
Ask for seller help.
You sure you want to go in there with seller help? I mean, it's sad but that was the case. There was rates were all-time lows. People were paying over list price, so asking for seller help
it was
an unheard of thing, and that's encouraging because like our show today is going to be about first-time home buyers, and traditionally
they need some seller help.
That's
sometimes.
one of the ways we help people get into a home. I mean, I always tell the story of, there were years when you were doing VA loans, which would allow 100% financing. We'll talk about that again in a few minutes. But people could get into houses with literally almost nothing out of their pocket because the seller could pay for all the closing costs and they'd put 0% down.
Yeah. Well, so to give you specific numbers, 175 of the sales, the 395s that sold, 175 of them received seller help, 55%. So significant increase.
They don't have any numbers as to the amount of seller help, just says they got it.
So yes, we do.
Okay, just curious.
Right. So the average amount was $8,700.
That's a good bit.
It's not a bad.
That's definitely
it's not a bad
helpful.
amount. Yeah.
'Cause one of the challenges when it comes to first-time home buyers is covering closing costs and down payments. So
yeah, and then the other metric that I want to just touch on is because this has to do with seller expectations, and I think that's something that's really important that we need to drive home to sellers now is that it's not the same market as we were in before. So if you take a look at all of the sales, the average list to sales price ratio was at about 100.66%. So people were getting list. But if you strip out auctions, and this is the telling thing, because auctions often take a very, very low original list price with the assumption that bidding is going to drive that price much, much higher. And I was looking at the average difference between the list price and where they sold in the auctions, and it was 50%, 200% higher than what the list price was. So they're a metric that really skews. And so if you pull the auctions out, if you exclude those, then your list to sales price was at about 95.58%. Right?
It's still
so
historically
it's very
high, isn't it?
it's very high, but it's showing you that when we were up in the 110, 120, 150 a year ago, now we're back into it's almost a more normal frame, right?
Yeah, so in January of 2023, we're seeing houses sell for a little bit below list and coming with some
seller help.
That's almost like a normal market. You
Right.
know, what was happening before, selling at the average home selling over list and no seller help ever was not a normal market. I still wouldn't say, or maybe I'm putting words in your mouth, this is not necessarily a buyer's market, but it's certainly getting away from an ultra seller's market.
I think that's a fair statement. We're not in a buyer's market yet, but the buyers are regaining some advantage, and sellers are waking up to the reality that some negotiation is required now.
So far this week we've talked is interest rates have come down, 4-month lows, mortgage applications are up, although they're up from the basement, but it's still slight improvement. And when it comes to buying a home, it might be a little easier to do it in January 23, much easier than it was even a year ago.
Much easier than it was before.
All
right, so let's talk about what was announced in the news just the other day that
You
we
were going to say
found
they announced, yes.
that they announced.
It's the FHFA,
right.
Federal Housing Financing Authority. They are the conservators of Fannie Mae and Freddie Mac.
And they have done something
It's awful.
something unreal. So we may talk about it again.
No, I don't know. Well, what they did, folks, there's these things out there called, it's at the beginning of the show, I talked about when people call you and they ask what your rate is, the rate depends on everybody's situation. And the reason I say that is it depends from the type of loan you have is the number one thing. But then if you're going with a conventional loan, these conventional loans, which is Fannie Mae or Freddie Mac, which is the vast majority, I think it's like 70% of the market Fannie and Freddie control. They have a portfolio of $8 trillion in mortgage loans, to give you an idea between the two, how many loans are serviced or owned by them. The FHFA announced new LLPAs, which stands for loan level price adjustments. Loan level price adjustments are based upon credit score, loan to value, the type of property that you buy, whether it's a primary, second home, or investment property, debt to income ratios, and I guess lastly there is a slight, they're different when it's a 1 unit versus a 2 to 4 unit property. Fannie and Freddie won't go any higher than a 4 unit property, neither will FHA or VA.
So this announcement had us all scratching our heads. Tell us why.
Let me back up. I said credit score. It's always been very important. People worry about credit score, and if you look at ads or hear people talk about it, 720 used to always be considered a great credit score. Then these loan level price adjustments came out, and 740 was the highest bucket. So you were always trying to get a 740 credit score to get the best rates. Well, they've introduced two new buckets, 760 and 780. So to get the best rate, folks, you have to have
Premium credit score.
a credit score over
The Sterling.
780. Yes, that's a really, really good credit score. I used to think I use my credit analyzer a lot to help people bump their score up. I think that thing's going to be running hot in the next few months, trying to help people.
Yes.
Not only that, they never used to have a loan to value below 60%. They actually have a 30 to 60% bucket and a below 30% bucket now. Oh, and then on top of everything, purchase and rate and term refis, non-cash out refis, used to have the same rate sheet. Now there's a purchase rate sheet. There's it's called a limited cash out, really no cash out. You get very little, you get a few bucks with that cash out. And then there's a cash out refinance. A couple months ago, they came out with new cash out. It really hammered or made it very expensive to do cash out for certain loan to values and certain credit scores.
Sure.
Actually, in some of the people with lower credit scores, it became more affordable or it cost less to do those cash out refinances. But just to give you an example, the old loan level price adjustments, when you had a 740 credit score and you're borrowing 80% loan to value, the adjustment was a half point. Now that's not a rate adjustment, it's a fee adjustment. It means you pay a half point more than somebody who had the same credit score and was only borrowing 60% loan to value. Now that adjustment is 1.5 points if you have a 740 score.
Which is a great credit score.
The new thing that they've introduced is debt to income ratio. There never used to be a debt to income ratio category in these loan level price adjustments. Anybody over a 40% total debt to income ratio. This isn't the housing. This is when you add your housing payment, total housing payment, which is your mortgage payment plus any HOA fees, homeowner association fees, or condo fees. Add that to your credit cards, car bills, student loans, all the other debts that are on your credit report. Right. If your debt ratio is over 40%, because Fannie and Freddie will generally approve you to 45, and people with higher credit score could go as high as 50%. You're going to pay another 3/8 adjustment for most buckets. Now, there's 3 separate matrices, and then there's a couple other ones for subordinating homes, whether it's an ARM and whether it's a 2 to 4 unit property. It's very complicated. In the old days, nowadays we have
if it seems like it's complicated and somewhat of a mess, that's because it is.
It is. But you used to be able, most lenders, some of them still do, produce rate sheets. And then you would go to these matrices and look at the adjustments to it and calculate the final price for a loan. Now everybody has pricing engines. Let's say you spoke to your neighbor and they got a specific rate, and you're wondering why yours is a lot worse or a lot better than what they got. It could be the specific situation. Yeah. And the troubling thing that you thought, the unreal part about it, Brad, is how it seems like they're hammering people with really, really good credit. For example, let's say you didn't have 20% down, but you had 15% down. And you have
still a very decent down payment.
It's a decent down payment.
Higher than the average.
Right, higher than the average.
Yeah, median.
And you have a 740 credit score, which is typically considered a good credit score. I still think it's a very good credit score. It's
Sure.
not somebody who makes late payments.
Right.
They just might have a little bit more on
Higher GTI, something like that.
or their debt or their balance, their utilization rate on a credit card might be a little higher than they should have it. Like it might be over 30%.
Sure.
They might have they could have a $300 balance on a $1,000 credit card.
Right.
Above 30% utilization, it tends to bring your score down. We're looking at a 0.75 points, 3/4 of a point on a $400,000 hit or higher hit than it was prior. So on a $300,000 mortgage, that point, if to get the same rate you could get prior, is going to be $2,250. Now, good news is there's some people out there that are going to see lower adjustments, but all in all, this was not taken well from the mortgage loan originator. And I think once the real estate agents see it, they're probably going to be complaining about it, especially the subjective part of a debt-to-income ratio. I talked to you about this. What do I mean by subjective when it comes to debt-to-income ratio? When you're calculating income, people look at income and can see it differently, i.e. the originator, the underwriter, and then when Fannie and Freddie buy it.
Right, right.
Think about that. Now, Brad, if you're somebody who makes $90,000 a year, that's your salary. No bonus, no commission income, nothing else. That's
Right.
what you're going to use to qualify. That's $7,500 a month. Calculating your debt-to-income ratio is pretty simple. But not everybody's like that.
Sure. Self-employed borrowers.
That's
or-
incredibly. How about this? Have you ever seen a nurse's pay stub?
No, I have not.
I should show you one time. Black it out. Because anybody who out there who's listening who's a nurse will know they can have several different pay scales depending on when they worked, where they worked, how long they worked, and it's not easy to calculate their income,
Sure.
right? There's a thing in the underwriting guidelines called effective income, and it's generally averages, but people can look at these different, especially if there's 6 different categories of income, and one's declining and one's increasing. An underwriter tends to take the most negative look at it. And the reason I see this being a problem is you may think they're below 40 quota rate, and after the fact, the underwriter reviews income drops a little bit. All of a sudden, you're at 40.5% debt-to-income ratio.
How
and
did
you're
that
gonna
happen?
hit it.
Right.
And you're under contract for a home, and it's not terrible. It's 0.375 is the adjustment. But again, on a $300,000 mortgage, I'm going to do this fast in my head. I think it's $1,125 in additional charges.
Yeah,
to
right.
get the same rate, or you'll bump your rate up an eighth. Basically, folks, the fee costs an extra half point, you might be looking at an eighth to a quarter point increase in rate. If it's a 1 point increase in fee, you might be looking at a quarter to 3/8 in interest rate. So it's troubling. It's something we'll have to deal with. But you know what? I'll work on clients getting better credit scores, because there
Right.
are some buckets that are going down, and it's better for them.
It is.
For
It's
example,
helping
if you,
some. Right.
that same 85% bucket I mentioned, if your credit score is 780, it's going to cost less.
Right.
So there's a good thing. So it'll be a challenge from somebody in my standpoint trying to help people out. To wrap this up, not to make it too complicated and wrap up this segment, is there is a certain segment of borrowers out there, and we'll talk about it on the scoop, who won't have to worry about this at all.
Drop it.
All right, Michael, right before the break, you teased us a little bit with some good news. Why don't you share what you were talking about?
Well, we were talking about loan level price adjustments, and I mentioned that there's a segment or a couple borrowers who may not have to pay any of the changes or the previous loan level price adjustments. In fact, they have 0 adjustments or
Do
loan
tell.
level price adjustments. One is first-time home buyers. That's the
Perfect.
That's the theme of the show.
Right.
As long as your income is at 100% of the area median income or less, you qualify to have none of those loan level price adjustments affect your interest rate.
So in the
And
Baltimore metro area, what's the median income?
I just happen to have that handy.
It's like you're psychic.
Well, actually, since I wrote it down, it will be memorized forever. I have that weird memory. $116,100 is what it is in the Baltimore metro area. In the D.C. area, which interestingly enough includes Frederick County,
right? Of course.
Howard County's Baltimore. It's one thing that always troubled me.
Well, geography's a challenge.
It's $140,500. And if you are at 80%, you don't have to be a first-time home buyer, but 80% of the area median income, which is a little over 92,000 in the Baltimore area, a little over 110,000 in the D.C. area, you qualify for either Home Ready or Home Possible. Home Ready is Fannie Mae's buying program, and Home Possible is, as long as you have a 680 credit score or higher, doesn't have to be perfect, doesn't have to be 740, or heaven forbid, like I talked about previously, 780,
right?
You qualify to remove all the loan level price adjustments. And another thing is, it's another advantage out there for Home Ready and Home Possible. If you put less than 10% down, they have preferred mortgage insurance rates to go with those programs as well. So this is a first-time home buyer show. We're going to talk about first-time home buyers. So I thought that
so positive news for
that would
for
be
the
a good
first-time home buyer.
segue and a lead into our topic.
Excellent. So we're moving into our next segment called The Scoop, Michael, where we're talking about first-time home buyers. So we're going to split this up a little bit. We're going to talk about, in the first part of the scoop, some of the challenges that first-time home buyers face and some of the normal challenges that they face in any given year, and then some specific challenges that we see first-time home buyers facing right now.
Mm-hmm.
And then in the second part of the scoop, we'll talk about some solutions for them. So let's get into some of those normal challenges, right?
Mm-hmm.
So one of the big normal challenges that first-time home buyers have is saving for that purchase, right? You got to have some money set aside.
Money, money, money.
Yeah, absolutely. So one of the biggest obstacles we talked about before was the student loans, but that's not the only obstacle that people face, right?
Yeah, when it comes to saving money or having the money to even consider maybe buying a home.
Absolutely.
You make good money, and yet you don't think that, or you find it impossible to put anything away or build any kind of savings to be able to buy that home. You mentioned student loans. Now, who knows? They keep extending the forbearance period. At some point, that's going to have to end, and you have to do it. But there's additional challenges. One is the cost of living these days with inflation, things going up, and rent. If you're not living with your parents and you're renting, you could see a heavy rent payment make it harder and harder for you to save money. And then there's one thing I notice as a loan officer who looks over first-time home buyers and young people's bank statements is the choices they make to spend.
Some of that discretionary spending.
Correct, and that's something that you can control. It's hard to, you want to live in a decent neighborhood, so you might have to pay a lot in rent. You've already graduated college, so you already got the student loans. Not much you can do about that. But there are some choices you can make when it comes to discretionary spending. And what I mean, often I'll get a bank statement from people, and they'll have, these days, kids use debit cards as opposed to, I use credit cards. They like to use debit cards, I guess, because they don't want to, maybe they were taught, which is a good thing, they don't want to spend money they don't have.
Right.
If you're disciplined, you can use a credit card and charge things up and then just pay it off every month. But when you do use a debit card, you get to see every transaction.
Mm-hmm.
Typical millennial or first-time home buyer, young first-time home buyer will have a monthly bank statement that's 8 to 10 pages long because it has every transaction in there, and it's multiple eating outs on a daily basis as opposed to bringing lunch to work, and then there's the daily coffee. And if you've ever added up what a Starbucks and a lunch at Chipotle cost you on a daily basis, it could be $20.
Significant
Multiply
amount of money.
that by 5.
My daughter just called me the other day, told me how excited she was because she bought a coffee maker for the home and could eliminate her Starbucks habit.
Yeah. I did that for my kids. I brought, they like iced coffee, so I brew coffee in the morning, but I brew extra, and by the time they get up, it's cooled because it's in a thermos. It's not on a burner.
Right. You just throw some ice in and nice iced coffee.
And I have the
good dad. You're a
the
good
flavors
dad.
and the creamers and everything that they like. I even have whipped cream at home for them. But anyway, that's something they could do. That's a choice you can have to make. If home buying is important to you, saving money is always typical, but these are little challenges.
Right.
And
so what are they saving the money for, right? So there are a few things, a couple of checks, right, that you're going to write during the purchase process and its settlement. So let's talk about some of those, right? One of the first things that a buyer's going to have to write a check for or wire funds for is the earnest money deposit, right? So let's talk about what that is. When you write an earnest money deposit, it goes along with your purchase offer.
Yes.
And
it shows you're serious about it.
It shows you're serious, right? It shows that you're putting some skin in the game. And so that earnest money deposit typically costs somewhere between 1% and 2% of the purchase price of the home. Now, when we were in the run-up in 21, 22, people were writing even bigger, larger deposits.
Does that really make a difference? I mean, because it doesn't change the sales price. Does it show that you're liquid? I've often wondered that because I've had
it's
advice.
The strength of the buyer kind of message that you're communicating.
They're that liquid right away. They could write a $20,000, $40,000, $50,000.
It's one strategy, a tool in the toolkit, right, to help the offer stand out. Right, so there's that. Then there's, once you get under contract, there's the due diligence phase, right? You have to go through your home inspections. You have to pay for an appraisal. So figure the home inspections. There's 3 home inspections that most people will want to have on any given home, right? In this area. That's the wood destroying insect inspection. That's fairly inexpensive. Then you have radon, which is hit or miss in this area, but colorless, odorless gas has been linked in high concentrations to some forms of cancer. And so it's a good idea to check for that and can be remediated. And then the other one that's kind of the larger chunk is the structural and mechanical inspection. And that's when the home inspector comes in and checks all the main systems in the home, looks at the plumbing, the electrical systems, all the appliances, checks for leaks, looks at the roof, the foundation, to really give you a good picture of the condition of that property, right? So that's an expense. And then if the property has a chimney or a pool or any of other number, if you're on well and septic, right? If you're on well and septic, that's an additional expense. So those inspections can add up.
I just recently got an inspection invoice because I needed it for a VA loan, and that's the pest inspection is required, and it has to be on there.
Right. Though the buyer can now pay for that.
Yes.
Which is a big change from the VA this past year. Yeah.
The buyer did pay for it in this instance. Anyway, this was, interestingly enough, it was Blue Crab Inspections that you know pretty well.
Great partner of ours.
And it was for all the above, well, septic water testing, and all that stuff. It was about $1,800.
Yeah, sure.
Reasonable.
Well, the well and septic is probably one of the larger portions of that, because depending on what county you're in, there are time limits as to how long the well yield test has to be done. But they're testing well yield, they're testing the water quality, so that means lab work, and then they're also testing the septic system to ensure that that's working correctly.
Right.
Yeah. So you have all the inspections, right? Then there's the appraisal, right? So the lender, Michael, you're going to order an appraisal when a buyer gets under contract.
And it's the one thing, from a lender's standpoint, for me personally, I think some lenders you can charge for credit reports, and you may be able to charge for a non-refundable application fee. I don't charge for either of those.
Yeah.
If it closes,
well, not all lenders are the same.
Yeah. The only thing outside of closing that I expect somebody to pay, because it's separate for me, is the appraisal, and it depends upon the type of appraisal. Conventional appraisals tend to cost a little less than FHA appraisals or VA appraisals. The cost can also be adjusted depending on the type of home. Is it
size of the property?
Size of the property, right? Whether it's waterfront or not, square footage, acreage, distance. It is from a local area. If it's a rural one, it's going to take a while to drive there. That could add a cost. But anyway,
right. Of course, you don't want people driving too far, because when they're driving from outside the area, that's a little bit suspect.
That might be a good topic for another show.
Can be a great topic.
A scoop segment, so to speak. But I'd say $500 to $600 is probably a fair
good average
estimate. Yeah. I mean, sometimes they are higher. The VA one I just had done was $625, but I've also had a recent conventional one only costs $475. So think $500 to $600.
I think I usually tell people $500 to $600 for that.
That seems to be a fair one. And it's not. You have to put, most times it's put on a credit card, so it can go on your credit card, but you will have to pay that credit card off. So right off the bat, if you're thinking about it, between home inspections, appraisal, and the earnest money deposit just to get started in the loan process, you're talking a couple thousand
$2,000. Yep. Right. And then you have the down payment.
And this is a good topic to talk about
Because there's a
tons-
myth,
tons
right? A lot of people
not only
believe,
misinformation or bad information.
Yeah, absolutely. So a lot of people believe that you
Still.
must have 20% down to buy a home, right? And where does that myth come from, Michael?
Well, it's because above that level, there has to be mortgage insurance. It's a little risky for the lender to make a loan above that, because if they were to have to foreclose and sell that property, there's expenses that are going to have to incur. And if you don't have at least a 20% down payment or 20% equity in the house, the lender probably foreclosing on that home and then selling it would take a loss.
Sure.
So they're not in the business of making loans and taking losses. So with a less than a 20% down payment, a mortgage insurance premium is going to be part of your monthly payment for most loans. Not all, but for most loans.
Right. And many people believe that that's just the worst thing in the world, right? To have that mortgage insurance payment in there. But for a conventional loan, what can happen with the the mortgage interest?
It's not for the life of the loan. It is something that can go away. And mortgage insurance premiums, much like loan level price adjustments and mortgage rates that I talked about in the first segment, is based upon someone's credit score. So the higher, if their credit score is higher,
the insurance is lower.
and you have two borrowers. Believe it or not, the actuaries of the mortgage insurance companies found out if there's two borrowers, which kind of makes sense. If you have two borrowers and something happens to one of them, at least you still have one income. The chances of, if there's only one borrower and one income's lost, that's tougher than it is if there's two incomes and one's lost.
Makes
So two
sense.
borrowers with high income will pay very low, and these mortgage insurance rates on conventional loans have come down. With FHA, they've been consistent for a long time. They haven't dropped. FHA's mortgage insurance premium has been the same since 2015. There are some hints that maybe they'll drop because that fund is pretty flush right now, but we'll see.
And with FHA, there's a little difference too. With conventional, once you get to a certain point, it will drop off automatically. With FHA,
for most people, it's for the life of the loan. If you use a 30-year fixed and you put less than 10% down, it's called MIP, which is mortgage insurance premium. It always confuses people. They have PMI, which is private mortgage insurance. For conventional loans, with FHA, it's MIP. It's a mortgage insurance premium. It goes down. It's based on the outstanding balance. Every year, it does go down. So as your balance goes down, it does drop. But if you put less than 10% down, it is for the life of the loan. If you do put 10% down or more with an FHA loan, which is not typical of your FHA buyer, usually they do it for the smaller down payment, which we'll get to in a minute. It goes away in 11 years if you have it for 10 years.
sure. So a benefit of paying 20% down is the avoidance of that mortgage insurance.
It adds to your monthly payment. You're borrowing there's two things. If you buy a $400,000 house and you put 20% down, your payment's going to be lower because your loan amount is lower than somebody who's putting 3, 5, or 10 or 15% down.
Sure.
And you're not going to have the mortgage insurance premium. But with conventional loans, like you said, it does go away. It goes away automatically once you reach 78% of the original value of the home on the original amortization schedule. But what you can do with private mortgage insurance is, if you do think you get to that 80% level, call your lender, ask them what you have to do. A lot of times when the house appreciates greatly, mortgage insurance can be dropped, and it can be dropped much faster than you think than that original.
We've been calling a
amortization.
lot of our buyers over the past couple of years because of such high appreciation, and letting them know that they may be in a position to have that mortgage insurance
So
drop
the
off.
lender may tell you the mortgage insurance company will require a couple things. They may require an appraisal to verify the value, or they can look at an automated valuation model, computer program, and look at the value and say, okay, yeah, it does. You're definitely well below 80. We will cancel it. But it can be canceled. You don't have to wait the normal term. And then there's the other thing. It's not going to happen now, but in the past, when rates were lower, sometimes you could refinance out of it. Like you might have been in an FHA mortgage that had mortgage insurance, your value's gone up, your credit's improved, and it made sense to refinance to get out of the FHA mortgage and the forever mortgage insurance.
Right.
So anyway,
But you absolutely don't need a 20% down payment
point.
to purchase a home, right?
No.
So let's talk about that. What is the minimum down payment? Because it varies based on the type of loan.
0%.
0% is the absolute minimum, and for what type of loans?
Well, there's two types of loans that allow 0% down. There's the VA, or Veterans Administration loan. For
One of the
veterans
best
out there.
benefits for our veterans.
It's one of the best products out there because it has a lot of underwriting flexibility with it. It seems the VA wants to do everything in its power to grant a VA loan to its veterans. There is a funding fee which can be added to the loan. It's kind of like it's a lump sum that gets added to the loan depending upon your down payment. But if you're at least 10% disabled veteran, and that's on your certificate of eligibility, that funding fee is waived. So you not only have no mortgage insurance, but you have no upfront funding fee. And VA rates are some of the best rates out there.
Absolutely.
The other program that allows 0% down is the USDA. That's a rural lending program.
Right, not available in all areas.
Correct. You have to be in, well, for example, Carroll County in our area. All of the county outside of Westminster qualifies. But for Baltimore County, if you're from this local area, it's basically above Butler Road.
Right.
For Harford County, you have to be inside and north of like the 95 corridor to qualify. But there are a lot of areas, and people are surprised that qualify, and it does allow a 0% down. Now, one thing I will say about the USDA loan is it has income limits. You can't make too much, and it also has pretty restrictive debt-to-income ratios. Generally speaking, they want to see a 28% housing, 28% of your gross monthly income is your housing payment, and your overall debt-to-income ratio is 41%. Now, you can exceed those levels. The only way you'll know if you can exceed those levels is running it through we call GUS. It's government underwriting system, as opposed to
Good old Gus.
we call it. Yeah, there's always acronyms in our business.
Right.
And or if it's a manual underwrite, sometimes you can exceed it, but you have to have some compensating factors: assets saved, time on job. There's certain things, credit score levels.
Right.
You have to have what's called compensating factors to exceed it. But those are the two 0% down. So they're the best. There's
And
a
then
limited
what's-
subset of borrowers who can qualify it, or
Right.
areas that can qualify
Right.
for it, but they're great.
Although what's interesting is when there's a VA loan on a property, if it's an assumable loan, and this was something that a lot of people don't understand, you don't necessarily have to be a VA borrower to assume a VA loan.
That is correct.
Now, we don't have to get into that. That can be a topic for another
Yeah,
episode.
let's
But
avoid these tangents because we have so much information.
right, yes, absolutely. So the next tier, right after the 0%, you've got
So I think we should do
3%.
this. Yeah,
Yeah.
next smallest down payment
Right.
can be a 3% down payment. Now, Fannie Mae, Freddie Mac allow a 3% down payment. The adjustments can be pretty large with that if you're a typical Fannie Mae buyer. But as I said earlier, a couple of those programs out there, either a first-time home buyer who is below 100% area median income, or somebody who doesn't necessarily have to be a first-time home buyer, but a home buyer whose income is below 80% of the area median income will qualify for the Home Ready Home Possible. Both allow a 3% down payment. So that's 3% of the sales price. And one thing interesting, if that's one of your challenges out there, when you're underwriting these programs, we only use qualifying income to see if you're below it. Unlike the USDA, which will look for all types of income, and it's not just your individual, it's household income. If you have somebody, the USDA, if you have somebody living in your home who's not going on the loan, but they get maybe some kind of government support or something, or they get some Social Security, it could be disability or regular Social Security, and they're living in the home, that gets added and may disqualify you from the USDA program. To get the 3% down payment, let's say you're somebody who makes $105,000 a year, but your base is $91,000 and $14,000 of that is an annual bonus or commission or something like that. Well, what we could do is just qualify. If you qualified using just the $91,000 and you're below the 80% area limit, we could use that to qualify you for the loan and get you in this program. So that's one of the things we do when we're analyzing it.
Creative approach, right? And then, so above the 3%, then there's another government-backed loan, the FHA loan, and that has a 3.5% minimum.
That is correct, and and then the nice thing about FHA is it allows, I would say, the widest amount of people, the largest amount of people to qualify for its loan. Credit score does matter to some extent, but you can have this down to a 580 score and qualify. You're going to get hit on your interest rate at 580. If you get to 620, it's a little bit better. And once you get above like 640, 660, you're going to get generally the best rates. Some lenders do give you a premium or give you an incentive if you're over 720 going with an FHA loan, but a lot of times people with that credit score look at conventionals. They have slightly lower interest rates than conventional loans. The reason being is there's that government guarantee, so the investors out in the market know that the Federal Housing Authority is going to be backing that up. Federal Housing Administration. Got to watch your acronyms here.
Right.
The government backs up those mortgages, so the investors in them will take a slightly lower interest rate. So they have the best interest rates out there. Now, they do have two aspects of the mortgage insurance. There's a mortgage insurance premium of 0.55% of the loan amount outstanding. Basically, what you do is you look at the average loan amount over the year based on your amortization schedule, and you multiply it by that factor of 0.55, then divide by 12, and that's the monthly amount. Because the premium is actually, that's why they call it a mortgage insurance premium. It's paid annually.
Right.
It's not something that's paid every single month. And then there's the other aspect to it, which is an upfront mortgage insurance premium. It's 1.75% of the loan amount. Now, you don't have to pay for that. It's listed as a closing cost, but it can be rolled into the loan. So somebody who closes with an FHA loan who puts 3.5% down is going to have a loan to value in the end a little over 98%. So they'll only have, the downside to going with an FHA is you have just a little bit of equity in the house.
Right.
But, if the rate's lower and values continue to appreciate, it generally isn't very long before you're looking.
That's some equity in the home.
Exactly right. And if it's something you're looking at now, one of the neat things about both a VA loan, I think it bears mentioning. I didn't look forward, and I don't know if it makes sense to mention it now, but I'm just thinking of it. Since we're at a period of higher interest rates, they're the easiest loans to do a refinance. They both allow what's called a streamlined refinance, and no appraisals needed. No income verification is needed, just employment verification.
So the cost of doing
as long as you're not
refi
making
is lower,
changes
too.
in the borrowers who are on the loan.
Yeah.
Same borrowers on the loan. We just verify that you're still working. Don't need your pay stubs and W-2s, and we don't need to send an appraiser out there. And that's important to know. In this, if you're somebody who's looking to buy a house right now, at some point, in the future, rates will drop. They've been dropping, and if they drop further, you can perhaps refinance and lower your monthly payment, make it even more affordable.
Sure. All right, so if we look at what the median down payment is, because not everybody chooses to pay the minimum down payment, and I think you're better off, if you can, to come up with a little bit higher down payment. It does lower your loan amount. And
we the two of us together work with the first-time home buyer, put 20% down, which is outside the norm.
Right.
Generally don't see that because it is quite hard to save that much money.
It's absolutely right. So, but the median down payment across all buyers, NAR, National Association of Realtors, puts out this generational trends report every year. And their 2022 generational trends report showed the median down payment across all age groups was 13%. Now that varies based on your age group, right? So it starts at about 8% on average for the 23 to 31 and all the way up to about 30% down on the 76 to 96. Now that's an age group, obviously. As you get older, you maybe owned other properties, you have roll those property values into the new home and you have a larger down payment, or you've had time to acquire more means. But so that's what the median down payment is. So another thing that home buyers have to save for is the closing costs, right? So that's a cost that you're going to pay at settlement, and it varies often according to the purchase price, right? Typically ranging somewhere between 2 and 5%, can be a little bit more, but that's the ballpark. And that includes all those government fees, lender fees, title fees, broker fees. There's a lot that goes into that.
Well, it also varies based on where you are locally. So a lot of people call it closing costs. I call it settlement fees because, in my mind, closing costs are what you have listed here: government fees, lender fees, title fees, and broker fees. But to get into a home, you have to establish an escrow account for property taxes and insurance. You
Right.
prepay a 1-year homeowner's insurance. And not only do you set up money for escrow payments moving forward with the 2-month cushion. Everybody asks, that's one question I get every time. It's universal, folks. When an escrow account is set up, we have enough money to make sure the next time they're paid, there's enough money in there plus a 2-month cushion based on what current taxes and current insurance are. The reason for that is that taxes and insurance tend to go up over time, and you want to make sure you have more than enough in that escrow fund.
Folks in zone 2 in Baltimore County just got their new assessment, and it's actually kind of funny. The number of calls that I get every year when the different zone gets, so there are 3 zones split into the county split into 3 different zones, 1, 2, and 3. West side is zone 1. The center is zone 2, and the east side zone 3. Zone 2 just got their new assessments, and so I'm getting all these calls from people in zone 2. How do I appeal this?
Oh, really? Was that?
Yeah.
Because
Because of all the appreciation.
Rita
Yeah.
showed me hers, and it wasn't that bad.
Oh, that's good.
Yeah,
That's great.
it wasn't that bad.
Well, she
so.
got lucky. Well, that's great. All right, so
But
then
anyway, let me finish up here. The closing costs. So those things to consider. So I think the 2 to 5% is correct. Depends on county. Baltimore City has higher property taxes, and the transfer and recordation or the government fees tend to be higher. So that would be closer to it might not quite be 5, maybe 5, depending upon the dollar amount.
Sure.
One thing that needs to be said, folks, is that percentage number is dependent upon where you do it and also the size. So the larger home you purchase, the smaller percentage of the sales
Percentage
price
of, right, yeah.
Because some of them are fixed, some of them are not based on the
right.
sales price.
The stamps and recording fees, that they don't vary. Yep.
So anyway,
Absolutely. Then there's the kind of general savings to be a responsible homeowner.
I'm proud of you for putting this in there. I have this conversation with borrowers all the time and buyers who are ready to empty their bank accounts
Right.
and become new homeowners. Now you're going to have the biggest asset, the biggest purchase you ever had. You may want to buy things to furnish the house with, and you also may need to repair things. Things go wrong with the house and get it fixed.
Well, let me just say that CNBC
Okay.
just did a report last year. 77% of buyers face an unexpected repair in their first year.
Interesting.
Right. So to your point.
Well, what I tell people when you're thinking about the cost of home ownership, be prepared to save about 1% of the value of the home per year. There may be a few years you go without having to make them.
That's a good barometer.
And but if you save that amount of money, that year when you need the roof, that's 2 or 3%, or something larger, an HVAC, some of these things.
But you might go 3, 4, 5 years without having to do anything.
A lot of things last long. Hot water heaters last, 15 years?
About 15 years on that, 10
so
to 15.
if you need to replace one, could be a 5 to 6 years.
Of course, now we say 10 to 15, and somebody's going to have a water heater that's 5 years old and has to be replaced. But
blame the manufacturer, not
right,
us.
not us, right. So, but, okay, so then...
But that's a good thing. The maintenance costs, it must be saved, and then also the emergency fund.
Yeah, you've got to have some
What's
money,
an emergency
right?
fund for?
Something's going to come up, right? Your car's going to die. You might get sick. You might be unemployed for a little while. There could be any number of reasons why you might need that emergency fund.
And so a good idea for emergency funds is 3 to 6 months, I would say. Have your total monthly bills, whatever they are, if you have that in the account. And, these are challenges, saving things but to be a responsible homeowner, to not run into things, not to be house poor, like we like to say, somebody who's living paycheck to paycheck.
Ramen, again, no disrespect to the fine makers of ramen noodles, but you don't want that to be your diet. Right. All right. So then,
next challenge.
In addition to savings, sometimes credit can be an issue. And we mentioned a little bit earlier that when you have some credit challenges, you can take a hit on interest rates. And so what's a good credit score? What's a great credit score, Michael? So we talked about it a little bit, but
earlier, prior to these changes with Fannie Mae and Freddie Mac, 740 was considered the best. Above that I used to always tell people it's gravy. It's nice having a 780 or 790 score. People get obsessed with the 800 credit score because that is seen as the gold standard, right?
Right.
800. There's not a lot of people. I mean, you'd be surprised. There's. I'd love to see the breakdown, but I want to say 15 to 20% of people out there have over 800 credit scores.
Yeah.
Having said that, they probably don't apply for mortgages a lot because they're set. That's why they've had a mortgage for a while and they've paid the balance down, so they have that. So it used to be 740. Now, obviously, with these loan level price adjustments, we want a 780. Now, if you're going with a government loan, a VA, USDA, or a FHA loan, 640, 660 will do just fine. It'll get you the best rates out there. You won't need much better than that.
Sure.
So,
Now, earlier you talked a little bit about with FHA how low you can go with credit score, right? So what's the real minimum?
580 is the minimum credit score. I mean, there are some lenders. I think 500 is FHA standard stated one, but that requires a 10% down payment. And the truth be told,
And if you're in that situation, that's going to be hard to have a 10% down
so
payment.
there's something that needs to be said about lower credit scores. When you see an advertisement or somebody mention that you can qualify with a 580 score, remember all loans these days are run through automated underwriting.
Right.
Now, if you don't qualify, you can do a manual underwrite, but manual underwrites generally need a minimum credit score of, say, 620 or 640. And the reason I bring up a low credit score is if you have that low of a credit score, you better have compensating factors of, let's say, a low debt-to-income ratio or a lot of money saved, assets or reserves. The reason being that automated underwriting is going to see that 580 credit score and probably not approve the loan if you're as much as it would approve, let's say, a 640 or 660 credit score.
Sure. So if somebody's got a credit score that's a little on the low side, what are some of the things that they can do to improve it?
So it's important to remember that a credit score is just a snapshot of your situation at a specific time, and that can change and that can be improved. Number one important thing about credit scores, about credit is on time. Number one important thing is on-time payments, obviously. Now, when you mention on-time payments, there's a lot of times that on-time payments aren't made and they get so bad they become collections, and specifically medical collections hit your credit report, and they can have a detrimental effect. But I will say this, and it's part of the credit law changing. Once you've settled a medical collection, it should be removed from your credit report. They have to remove it. They have to call them, and that can make a drastic improvement in your credit score.
How many points? I mean, you've had some of those situations,
Go
right?
up 60 points, 70 points,
Pretty
80 points,
significant.
removing an $800 collection. It's amazing. So that's important to remember, folks. So if you have one of those collections on your credit report, that's a challenge. Somebody in my position, when they pull the credit and see that, will discuss that with you and see if you have the ability to pay it off. Removing that can have a drastic input. And I actually have at my disposal a thing called a credit analyzer. And it has two aspects to it. One of them is the analyzer where I put in a score I'm looking for, and it'll give me ideas or things it can do. And then there's another thing that has a what-if simulator. The what-if simulator comes in handy when it comes to taking something off that's derogatory. Like, what if this was paid as agreed, or what if this was removed? Doing that, it'll tell me what happens. Now, with that one, it almost always doesn't change it immediately. It's something a month or 2 months down the road that it will change. It'll give me the credit score today or a month or two down. Then the other thing I can do, the analyzer often will tell me to pay loans down or balances down, specifically on credit cards, because the number two important thing on credit score is what is called utilization. Keeping your balance of your credit cards below a certain level. So,
and it's not necessarily always paid off.
Correct. I was going to get
Right?
to that. Exactly right.
Great.
So for utilization, anytime you go above 50% of the maximum value on a credit card, it really starts impacting. And if your stuff's maxed out, that can be pretty detrimental. It looks like you're desperate, like especially if you're applying for new loans and you're currently maxed out on your debt. That doesn't necessarily look good. It tends to weigh on it. The best idea is to keep it at a max 30% or below. It's best to keep it below that. In fact, if we're talking about responsible home buyers, we'd like to see you not carry any credit card debt given the interest rates. I guess if you're smart, you can always play that balance transfer game, that zero balance transfer game, 0%, but you're paying that 3% fee every time, but it'd be best. So that analyzer, you're exactly right. Sometimes to get somebody's score up, it will tell me to be specific. It's very specific in what it'll tell you to do. Pay this amount to that card, this amount to that card. More times than not, I'll send it to people and they'll just pay it off in full, and it didn't say that. And believe it or not, keeping an $80 or $100 or $120 balance on that was better than paying that to zero.
Maybe counterintuitive, but it's a good point to raise.
At least follow my advice to the T, because if you do that and then give me the proof that you've done that, i.e. a statement or online transaction history that shows their balance is paid to this level, I can send it in and do what's called a rapid rescore, and within 3 to 5 business days have your credit score pulled. Now, if I pulled your credit last week, tell you to do it this week, and then I'm 2 weeks in, I have 120 days from the original pull of that credit score that credit report is good. So we still now have that credit score good for 3.5 months. If you wanted to pay that thing off in full, go ahead after I've rescored you.
Right.
See what I'm saying?
Yeah, absolutely. That's a great point, Michael. Thank you, and thank you for making that distinction. So there's a couple of things that I think we see. They have us shaking our heads sometimes. People self-sabotage. There are some things that you should never do when you're buying your home because it can affect your credit, right? So one of the biggest things, right? You think about buying a home and you think, okay, I'm going to need furniture in this home.
Right.
So you go to the furniture store and they have these great programs, 0% down, 0% payments until January of 2025, right? And so you think, oh, great, that's not even going to affect my credit. But it
Well,
does.
especially if you just heard me say that I've pulled your credit report. And that credit report is good for 120 days. People hear that. But remember, the underwriter is relying on that credit report and that credit score for your debt to income ratio, but they also pull a report from CoreLogic. It's called Data Verify, and it has other aspects. They're looking for potential other properties that you own that could have debts, and right before closing, it'll say if you've opened up any new accounts. And if you had, they're going to ask what's happening, what's the balance on it, ask for proof of that. So it's never a wise thing to make any large, if you have a credit card, it's okay to use your credit card. We're talking about opening new accounts. Like,
right.
Sometimes people get scared when I tell them not to open any new accounts, and then they've stopped using their credit cards during that 1 month underwriting process. It's perfectly okay to charge your groceries, fill up your gas tank. If you see a sweater on sale, go ahead, and you can afford it. It's in your budget.
Right.
Buy it, but don't do what you just said. Don't go open a new, because that 0% is a new credit account.
Don't open that. Don't co-sign for anyone, right?
Else.
Don't co-sign because then you are an obligated party on that.
Now, in a rare case, an emergency happens. I had it happen one time when borrowers of mine, I told them they were following it. They were under contract to buy a home. I told them not to do anything crazy. One of their car was old. They were planning on getting a new one after we closed.
I'm glad you're saying this because that was going to be a question for you.
Oh,
it's perfect.
We're on the same page here. They called me all panicky, saying my car doesn't work. It's blown up. It doesn't make any sense to fix it. I needed a car. I know you told me not to do anything. What did I do? I said, relax a second. I think you have some wiggle room in your debt ratio. Let me take a look and see what it'll do. And I said, look, as long as you keep your payment under this amount, you'll still qualify for that loan. I will need the information. I'll need, the monthly payment. Basically, when you go and finance it at the car dealership, they'll give you a finance statement and say what the monthly payment is. And I'll need that, and we'll need to prove the loan. Now,
but what's so important about what you just said? Folks, this is something really important to think about.
Let me know.
Let the lender know
what's going
on
so they can advise you.
Before you have to take that step. Call.
Especially now, it's more important mentioning the adjustment for over 40% debt to income ratio, right?
Becomes
so if
more
that
of a
puts you
challenge
over
now.
it after the fact. And I bet lenders are going to be looking at once these price adjustments, folks, aren't going to be until they're for loans delivered to Fannie and Freddie after May 1st. Most people think February and March will be the time they'll start hitting rate sheets. So they're going to be coming up pretty soon. Today being the 21st of January. So, that's very important too. So I might call you up and suggest something else. If you can do it, maybe I don't know. Put in if one of the borrowers isn't on the loan or something like that. If it's a couple and only one person's on the loan, put in the other person's name. There are strategies you're going to look at. But if you need a car, you need a car. And if it's going to mean a 3/8 adjustment in fees, you're just going to have to deal with it. But just let us know. Nobody wants surprises at the end. I'm dealing with a loan I'm trying to close right now, and it's no big deal. But it came up pretty late in the thing that the borrower has. He has an ownership interest in properties a few states away, North Carolina, and it came up when the underwriter pulled that CoreLogic report that I talked about, and it was his family members just adding him to family homes that aren't worth much. There's no mortgage on it. He has no monthly obligation, but proving that he has no monthly obligation means I got to get an abstract search showing there's no liens against the property.
I think that's another one of those great topic for another episode.
Absolutely.
I think we need to bring in our buddy Ed to talk about ways that you can protect your property and protect your heirs without creating situations like this.
Yeah, interesting enough, I don't know, it's North Carolina. It didn't look like these were taxable events, but if you're not married in this state, it might be a taxable event. So that actually is a good thing for the next time.
Yeah, good. Okay, so
More challenges.
right now, in this market, they're facing maybe some additional challenges that they haven't been facing for a while. And there's two things, right? The interest rates and what's been going on with the market. So let's talk about that. We're not we're not in Kansas anymore. We're not in 3% territory anymore.
We've seen a rapid appreciation of homes because of the limited supply and large demand of homes.
Now, 6%, 6.5% even. Historically, not a horrible rate, right? But it's much higher than what people have been seeing for a while.
And it adds to the monthly payment, yeah, absolutely. You
Right,
had
so-
some numbers on this, didn't you?
Right, yeah. So if I just ran a little bit of an analysis, if you were looking at a $350,000 home, right, and you put 10% down, if you were paying a 3% mortgage rate, your payment would have been ballpark about $1,900, right, at 3%. If you go to 6%, that payment becomes about $2,500. So it's about $600 more per month. So that's one of the things that happened actually with, and we'll talk about this in in a little bit, with some people who were buying new construction homes, right? That they were surprised by some of those increases, and it had a little bit of an impact. So, and we'll talk about that. But anyway, so if you can afford that extra $600 a month, great. But if you can't, then you have to look at maybe resetting your expectations a little bit, right? So if you wanted to keep that payment at about $1,900, then instead of a $350,000 home, then you're looking at more of a $270,000 home, something like that, right? You just have to readjust. And that's something that I think buyers need to understand. It's not an impossible time to purchase a home right now, but you have to moderate your expectations a little bit, right? The HGTV special may not be within your means at this point, but that doesn't mean that you can't move in to a great home that can be a wonderful property for you to live in, and then over the years you make that property your own.
Well, there's all those decisions you have to make given the higher interest rates as well. We mentioned the disposable income or discretionary income earlier. If you make some sacrifices, your budget might have to be stretched. You might have to get a house you like and really like, you might have to make a higher monthly payment than you otherwise would be comfortable for. A couple strategies or things you can do. One is really watch your discretionary income, especially in the short to medium term. Secondly, another thing to think about, now there is no guarantee, but given the interest rate cycles, and we're at a high interest rate point in the cycle, specifically because the Federal Reserve has been raising rates to quell inflation, they've already started coming down, and they're not down enough for refinances to make sense for a lot of people. But if they continue to drop, as they have in the past, if the economy slows enough to slow inflation down, the Fed will cut interest rates.
And
interest rates will come down.
And that gap between the 10-year and the interest rate will narrow a little bit more if
rates come down a little bit, and people will be able to refinance, and you
Sure.
might be able to lower your monthly payment $300-400, especially at the price point that you mentioned as far as your calculation is concerned.
Mm-hmm. Absolutely. All right. So that's one of the reasons why getting your pre-approval is so important, right? You have to understand what's going to be possible in this new mortgage rate environment. So you can't just say, "Oh, I'm going to go, run out and start looking at homes, and I think I should be able to afford this." The pre-approval is such an important.
Well, and it must be updated. Now, the reason I say that is last year people had pre-approvals and then finally got around to getting their offers accepted. With the interest rates being higher, it might have been a struggle. Rates have improved here. We're at 4 months lows. They're still higher than they were a year or two ago. But it is important and to have an idea what you're looking at for a monthly payment. You won't know the exact monthly payment until you identify a property, because homeowners insurance and taxes can vary a little bit. We can give you, your interest rate is going to be the interest rate the day you lock. Short term and medium term, there are differences in mortgage rates. They can go up, they can go down, but you should have a budget and you should have an idea of what you qualify for. Like when somebody comes to me to be pre-approved, I never ask what price point they're looking at. I start it by asking, what monthly payment are you comfortable making? And
Which is so important.
They'll usually give me, and a lot of times the answer is a comfortable payment if we had to, we could stretch it to this point, but this is what we'd be more comfortable with. And then I can back into a dollar amount. Once I know their down payment and have an idea where they're looking, get a good idea what price point they should be.
And that's such a great approach, Michael, because not everybody looks at it that way. Some lenders will qualify somebody and say, hey, you qualify for $1 million property. Should you spend that? Not necessarily, right? So I love that approach, and that's one of the reasons why we're sitting here today. But anyway, all right. So, and then there's the market activity that has been a challenge, right? There's been a significant amount of appreciation. Now, nationwide, there's been more appreciation than in here, but I have some statistics that I pulled from, again, from National Association of Realtors. Housing statistics. So in 2017, we were at the median sales price was $280,000, right? 2018, we moved up to $290,000. So $10,000 difference. That's 3.6% increase. It's kind of a normal amount of appreciation, right? When we moved to 2019, moved up to $302,000. That's another 4.2%, right? Still within that range of reasonable. Then we got to 2019 and it jumped up to $330,000. That's a 9.2% increase, right? And in 2021, we went up to $361,000, another 9.4%. So we're at almost double what a normal amount of appreciation is, right? But nationwide, we were hearing stories about 23, 24, 25% increases in certain other areas of the country, not here, right? So then moving into 2022, appreciation moderated somewhat, right? If we looked at what we were looking at from the first half of the year up until about May or so, before the shift started happening.
Well, that's when interest rates started going up.
That's when interest rates started going up, absolutely. We would have been probably on track for another close to 9% year, but the Fed acted and started raising rates. So we wound up with still appreciation, jumped up to a $385,000 median sales price, an increase of 6.5% from the previous year. But it moderated. Now contrast that with my favorite case study city, which was Boise, Idaho, right? So Boise, Idaho started out in 2018. Their median price was $285. 2019, $325, 14% jump. This is pre-COVID. They still had a lot of activity, a lot of appreciation, even before COVID happened. But then COVID hit, right? 2020 jumped up to a $400,000 median price. 2021, a $500,000 median price. These are 23 and 25% increases each year. Over a 4-year span, they had a 75% increase in the median sales price. And then in 2022, they peaked in about May, right before the Fed started raising the rates, close to $585,000. But where do you think they wound up at the end of the year?
585 was the high.
585 was the high.
And you're asking me what happened in December of 2022.
Right.
Median, I would say, 420,000.
Well, you're close, but you were a little more aggressive on the drop than they experienced.
Well, I was thinking, I tried to do math. I was thinking it might have been a 20% pullback given how fast it went.
So, yeah, right. But there's still that dearth of inventory, so it kept it up a little bit, but it was a pretty precipitous drop, down to 485, right? So
that's a lot.
So yeah, but not as bad from the previous. It's only a 1.6% drop from the previous year, but from their high, a little bit more significant, right? From May of 2022. But they're one of the areas that's seeing contraction versus what we're seeing
Holding
here.
steady, and there's a few other areas that probably have seen contraction. And again, to your point, it's the hottest real estate markets that were out there, the ones that saw the fastest and the most appreciation. I think Florida's in my future.
Sure. Yeah.
Okay.
Sure.
For retirement, when at some point when I retire, and
You could be that guy in Florida that all the memes are about.
But I looked at. It's amazing to see how I get if I ever show any interest on an app, say Zillow, you'll get text all the time about new properties.
Right.
And I always look at them for fun. And one thing I always look at is what the prices were 6-8 years ago as to now. And some of the areas down there have seen 200, 300, 400% appreciation in not just not in 1 or 2 years, but I'm talking 8 to 10 years. That's quite a bit of appreciation. And I would think similarly, areas that saw such fast appreciation home because of bidding wars and such, and a lot of it was migration, people moving from higher, wealthier states had a ton of equity and money to throw at a house.
California money in Boise, the same story.
Florida's got New Yorkers, New Jersey, Philly people.
Exactly.
Right? Coming down there with all that money. And so I would think, I don't know, you might see a pullback there, but we're not going to see the drop-off that we saw in the housing bubble at all. But, the hottest areas probably will see some pullback. But in the Maryland area, like we've talked about before, I'm not sure that we'll see much of a pullback.
Well, there was a stud. Lance Lambert does a lot in Fortune magazine about showing where the shifts have occurred and gave some expectations. So he pulled some maps together based on the Zillow estimates, right, and the expected shift between November of 2022 and November of 2023, right? So across the country, the most significant shifts are in the minus 10% range, but there are some areas where they're saying that there could be a 10% increase. Right here in our area, we're kind of in the neutral territory where we could see maybe some adjustment, but not a significant adjustment. Now Moody's,
I guess the places for increase. So interest rates won't matter as much as some people are saying as far as calling for a extreme pullback. And I would imagine it's inventory or lack thereof.
Inventory is a big factor, absolutely, and that's what keeps the price up. Yep.
So we're bringing this up because these are challenges that first-time home buyers are dealing with. We have seen a pretty quick increase in mortgage rates. Now they've pulled back a little bit, but we've also seen an increase in property values or home prices.
Yep.
And that'll affect affordability for the
absolutely
first-time.
So when we come back, we're going to talk a little bit more about some solutions that we have for first-time home buyers.
Try me.
Welcome back to Be Real, the Maryland real estate podcast. Earlier in the previous segment, we were talking a little bit about the challenges facing first-time home buyers. This is a show about this week's show is about first-time home buyers. Again, there are some serious challenges facing first-time home buyers. One, the higher interest rates, the appreciation of or increase in sales price of homes. But we have some solutions for people. Let's talk about it.
Yep.
First of all, cash coming up with sources for down payments. We talked. There are some 0% down payments limits, but by and large, most people have to come up with 3.5%, 5%, 10% down payments, some kind of down payment.
Right.
So one of the easiest ones, obviously, is savings accounts. Right.
Hopefully, you have saved over the course, and we talked about some of those habits that can impact your ability to save before. But yep, absolutely, it's a prime source for.
Now, savings can be the liquid type of savings you're talking about, right? Banking checks, savings and checking accounts. But there are other types of savings that are long-term savings, and what I'm speaking about is your retirement savings. Now, I'm not suggesting pulling it out for down payment. You talked briefly about that. In the crazy real estate world, people are literally to come up with cash offers for liquidating savings, retirement accounts to make a cash offer in hopes they could sell their existing house and put it back in, and it causes a very stressful period. If you pull money out of your retirement account early, it can be if you don't pay it back as a rollover in 60 days, it's a 10% early withdrawal, and on top of the taxes that you would pay. But what I'm talking about is if you have a well-established 401k or IRA, there are times where you can take out a loan against that retirement account. And what you do is you pay yourself back. Two things to think about. One is it's a monthly expense. It is part of your expenses. It's going to be deducted out of your paycheck, generally speaking. So you're going to have less take-home pay. So even though you qualify based on gross pay, you may want to think about how it's going to affect your affordability, especially since there are higher interest rates and higher payments. The other thing about retirement accounts, in addition to the monthly expense or the payroll deduction it's going to be, is does it affect your ability to contribute further? Sometimes when you have a loan against your 401k or IRA, you're not allowed to contribute to that any longer. And if that is in your plans, that's something to think about moving forward. So if you're going to do something like it is out there, and I've seen people do it, take out loans on their retirement accounts to help come up with down payment or closing costs. But if you're going to do it, make sure you can handle the additional expense or the deduction from your payroll. And if you were considering or planning on putting more money, and this is going to prevent you to do it, you might not want to do it, because the payback period, you can pay it back as soon as you want or as fast as you can, but generally the loans are 3 to 5 years. And you do pay it back with interest, but you're paying yourself interest. So it's not necessarily a bad thing, but you want to go into it with knowing all the options.
Absolutely. So there's some other sources.
So we got
of
savings.
funds.
So past savings, what else can we do?
Right. So gifts can be another source, and there were some increases actually to the gift limits, right? Fairly recent.
Right. When it comes to gifts, yes, the annual amount of gifts go up every year. The amount that they can give up, is it 16 or 17?
16 or 17,000, I thought, and it was for each parent, right? So each parent could give. So if you had two parents,
look that up while you talk about this right now.
I think that's what I remember. If you had two parents, each parent could gift to each child. So you could get a total amount of something like $68,000 or something along those lines, wasn't it?
If it's a married couple, let's say it's just one of the parents. Let's say the husband's parents want to gift them money for it. If they wanted to use the annual exclusion amount, the father could gift each of the son and daughter-in-law $17,000, and the mother could give them $17,000 each. So that's $34,000 each. That's a total of $68,000. A lot of times people worry about that number, and I
actually got the number right. Wow.
Did have the number right. A lot of people, and obviously, whenever I say this, contact your tax advisor is always the best advice.
Absolutely.
But beyond the annual exclusion amount, there is a lifetime exclusion that I believe it used to be $5 million. It's gone up. I think it's over $11 million. If you exceed the annual exclusion amount, it just means that the person making that gift would have to file a gift tax return. The IRS wants to keep track of the lifetime exclusion amount, so you'll have to file that. But in most cases, when we're talking about gifts, Brad, for down payments and closing costs, we're, to help get somebody in a home. It's generally not the entirety of the down payment or closing costs. It's generally in a $5, $10, $15, or $20,000 amount.
Just a little boost.
Yes, it's something to help get over the edge. Now, not everyone has parents who have the ability to make their gifts.
Right. But there are some other sources.
But they make decent money. They qualify for a loan. They've saved a little bit, right? But they can't quite get over the hump. In that case, there's different kinds of things out there, aren't there?
Absolutely.
What are we talking about?
Let's talk about the Maryland Mortgage Program.
Well, it's a grant program. There's different kinds of grants, but one we want to focus on, which, since we're in the Central Mary area that everybody knows, is the Maryland Mortgage Program. And they have different aspects to that. Now, they have, most often ones uses what's called the DSELP loan, down payment settlement assistance loan. You can get money, it's a percentage of the sales price up to a cap, and they will give you money that you can use for your down payment or closing costs. One thing that needs to be said about that is it's not free money. It's a silent second. It's a loan that goes against the property. It's at 0% and you never have to make a payment, and there's no interest on it. However, when you sell the home or if you refinance out of it, that amount has to be paid. So it's something to look at. It's a possibility out there, but there might be other options out there to get over the edge. One we mentioned a little bit earlier about it, and we might be getting into it when we're talking about closing costs.
Sure. Is
seller credits.
Absolutely.
They can help. If you've covered the down payment, sometimes seller credits can help cover those things. And the other thing is, as interest rates normalize, in the past, a strategy we often used to do was look at your interest rate and maybe bump your interest rate up. And if your interest rate's higher, what the lender will do is give you a credit. I make the same amount no matter what interest rate you charge. A lower interest rate can cost you money or points. In the same respect, a higher interest rate can give you a credit or money that you can use towards your settlement fees.
And if that is your particular issue, sometimes that can make sense.
It makes sense in the fact that the Maryland mortgage program tends to have higher than market rates. Obviously, it's getting paid for some way. So you look at the rate you could get with the Maryland mortgage program and what you can get as a 0% no payment loan, and maybe look at if I take a similar rate in the open market, can I get a lender credit that helps me cover the same amount towards closing?
Right.
So.
And then there's some other programs, like if you want to live in Baltimore City, there's the Live Baltimore Trolley Tour.
The Trolley Tour.
Yep.
There's keys for employees. Certain employers will match
Live
some
near
of these
your
grant
work,
programs.
right?
Live
Yep.
near work.
Absolutely.
There's lots of little programs. These are all things you should look into as a first-time home buyer. But they may or may not apply to you. There are another thing about the Maryland mortgage program that people forget. It has restrictive debt-to-income ratios. FHA will allow you to go to 55, 57% sometimes debt-to-income ratio. That's capped at 45% debt-to-income ratio. If you have, it's hard to exceed the income. Most people who apply for these grant programs don't exceed the income or asset, but there are caps. You can't have too much assets or make too much money to qualify for these programs. Yeah. Like any government program, it's meant to help low or moderate income people become homeowners, which is was a good plan or good idea.
Right. So one of the other things that's super important with regard to first-time home buyers, but any buyer really, is the idea, and we alluded to this a little earlier, is the idea of getting a full pre-approval, right? And there's ways, it's about helping to make the offer stand out, right? And a full pre-approval can be a big differentiating factor.
Right.
And there's a difference. Not all pre-approvals are the same. And I'll
there's
call them different
different terms that are
things.
used out there.
Pre-authorization versus a pre-approval.
Well, is the pre-authorization term, I've also heard it called a pre-qualification.
Pre-qualification.
Generally speaking, that means somebody's I've pulled your credit, I've run automated underwriting, and I've taken your word for your income and assets.
Right.
You're qualified based on what you've told me.
Right.
Now, it's a good first step. You have an idea, but a lot of times people, from a loan officer standpoint, a lot of people, when you ask them what they make, will tell you what they make. They'll look at the bottom line, but I'll give you an example. Somebody who makes a salary and has just started earning commissions gives you what they made last year as their annual income, but they don't have a 2-year history of that commission, and that's a significant portion of their income. If I were to use that number to qualify them, let's say their base salary was $60,000. In 2021, they made 0 commission, but in 2022, they made $60,000 in commission. The underwriter might not think that 1 year of commission is enough to use that as qualifying income.
Right.
So they may only use the base salary. So you'd be doing yourself a disservice. So if I take your word for what you make, that's why it's always good to verify those things. Same thing when it comes to assets. Somebody telling you what they have as opposed to verifying their bank via their bank statements is a huge difference. Now, we don't necessarily need to get pay stubs and W-2s and bank statements from you. In this modern world, there are electronic verifications that can go a long way and, to your point, make your offer stand out.
Right.
I have, in the past, using a website called The Work Number, been able to verify. It's an Equifax website. Verify people's, and many major employers submit data to this. If I can verify your employment and income via that website, I can also send you links that you just have to answer a couple questions to verify the money that's in your bank statement. I could do this all electronically. Don't ever have to have you email me or send me a W-2 pay stub or bank statement. If I do all that ahead of time and then run automated underwriting, and I get an approval that accepts your income, that accepts your assets, you are essentially done on your loan process except for the title work and except for the appraisal. Now, beyond that, if you're somebody who is fortunate enough to have a 20% down payment, and I run automated underwriting, and it accepts the value that I've entered into the system, I have an appraised value acceptance. I have income and employment verification and assets verification. All we need is title work. If you have that going in to submit an offer, you think you'll stand out, Brad?
Makes it so much stronger from the seller's perspective. And I'm glad that you said from a loan officer's perspective earlier, because there's also how the seller perceives the degree of financial readiness that the buyer has.
That's a great point, because you have to think about the sellers when they're considering offers. Now, this is not on our outline, but it made me think of something like this. Now, when someone's submitting an offer, now we can do those for Fannie Mae and Freddie Mac loans. They're tougher to do. You're not going to get all those verifications for government loans, FHA and VA loans. Now, those loans make sense for a lot of buyers out there. And last year, or during the house, when interest rates were all-time lows and housing was crazy, like they were getting dozens of offers for every single home, submitting a government pre-approval letter pretty much meant you weren't getting your loan accepted.
Well, it was tough. It was really tough for those buyers.
Has that changed at all? Do you think it's
eased quite a
easier?
bit, and we're seeing many more FHA, VA, USDA, and it's good to see, because that opens the buyer pool, gets more people the opportunity to achieve that dream of home ownership. Right. Absolutely. All right, so
that's a great thing for first-time home buyers to because that was so hard for them in the past. It's making it easier now, because this is a program. Those programs specifically, the FHA program, seemed to be geared for first-time home buyers.
Sure. All right, so there's another solution that may be good in this higher than we've seen.
This is for the buyer, right? For the first-time home buyer,
right? In this higher than we've seen interest rate environment, it's called the rate buy down, right? Mm-hmm. So let's talk about that a little bit.
So interest rate buy down, basically what happens is either from the seller granting you credits or the lender giving you credits by you taking a higher than market interest rate. It has to be paid by those two. Mm-hmm. The buyer cannot pay for this. You can do a temporary buy down. What a temporary buy down is, the interest rate for the first year or the first 2 years, or in some cases the first 3 years, you can buy down the interest rate. Most common, I think, is either the 2-1 buy down or the 1-0 buy down. So a 2-1 buy down would mean if today's the rate was 6.25%, mm-hmm. you would make a payment on the first year based on an interest rate of 4.25%, and then in the second year the rate would be 5.25%, and in year 3 the payment would go back to the full 6.25%. Now,
the idea, though, with those types of loans, with the buy down, is that over time, and it's not a guarantee. We want to make that very clear. Yep. It's not a guarantee, but over time, if rates do moderate, then you may have the potential to refinance that loan.
I would think most people looking at a buy down are thinking exactly that. They're thinking of, all right, I'm going to get in the house, and this will help me afford it now. Now, I must say that you have to qualify at that full rate. It doesn't improve your ability to qualify. You can't qualify at that 4.25% or 5.25% rate. You must qualify at the full 6.25% rate. But yes, interest rates go up and down. We're at the higher part of interest rates. Most people are expecting the interest rates to come down. I'm not so sure they'll ever come down to where they were during the pandemic, but the lows of the interest rate cycles in 2012 and 2016, it almost seems like it's a 4-year pattern. We had 2012, 2016 were interest rate lows. 2020, they were going down at the end of 19 into 2020, might have hit another interest rate low had not the pandemic hit, and then Fed jumping in on the pandemic and making rates lower than they would be otherwise. So maybe 2024 is when they raise, and a lot of people are predicting that. I shared with you, we didn't bring it up earlier, but I think the Mortgage Bankers Association thinks the 30-year fixed rate will be about 4.4% in 2024.
In 2024.
Yeah, so that would go along with what we're saying. So the only thing you need to understand again about the buy down is it has to be paid for via the seller. Now, we're talking sellers are giving credits out there, right? So when you get seller credit can be used to pay for the buy down, or it can be used for closing costs. If you have down payment and closing costs and you want to help your affordability, at least in the short term, that's a great use of seller help if you're going to get it. Alternatively, from a lender standpoint, it might be hard to pay for the 2-1 buy down. There might not be a premium, but you could do the one buy down. I was looking at somebody recently. I think I had to bump the rate 0.25%. like let's say they could get 6.25%. What I was going to do is bump their rate to 6.5%, and they would make a payment for that first year at 5.5%. Made it more affordable.
Right.
And 12 months from now, 12 payments from now is going to be 2024, so there might be an opportunity. Now, if you're going into that, you need to be prepared and be okay with making it. If it doesn't happen,
you have to be able to be ready to pay that higher.
But I think, like I said, interest rates are cyclical, and it sure seems like the next low in interest rates might be 2024.
Right.
Might be sooner, might be later. No
Right.
one knows.
All right, so let's talk about this. Another possibility for first-time home buyers is the idea of a loan assumption, right? So there are a lot of sellers out there who either purchased or refinanced and are sitting on a rather low interest rate right now.
Mm-hmm.
And that interest rate, depending on the type of loan, may be assumable by the buyer.
Yes.
So let's talk about how that works.
So it has to be a government loan, either a VA or FHA loan. Those are the only loans that are assumable. And the way it works is the person buying the home can take over that mortgage payment and that interest rate. Now, the term remains the same. You're not going to go out to 60 years, so you're going to be making a payment on what they're making. You must qualify for it. It's not just readily assumable. Anybody can. They have to they're going to verify that you make the income to qualify for that. The biggest challenge, I think, with assuming a loan, depending upon how long it's been had and the difference between the loan balance and the value of the home, is coming up with that difference.
The difference. Right.
So let's say I gave you an example, or you and I talked about it a little bit. Somebody was referred to me who wanted to buy a $560,000 house. There was an assumable loan, a little over $400,000, that the rate was at 2.375. Well, it's an FHA loan. They still have to pay mortgage insurance. Even with the mortgage insurance, it's a payment that would be lower than if they did it. So now they have to come up with the difference between the $560,000 loan amount and the $400,000 balance owed on the existing mortgage. $560,000 sales amount.
Right.
And the $400,000. Most cases, what they would look to do is get a second mortgage out there. Hopefully, a credit union, a small bank, local bank would be able to come up with either a home equity loan or a home equity line of credit. Some of them will allow you to go as high as 95%. So you would probably, at a minimum, maybe more, have to come up with 5% down and close the costs to complete.
Could be a
that
great
deal.
solution for someone, though.
It would be, and it's also a selling point. I had a client of mine who could not sell his home in Dundalk, was having trouble until I reminded him that he had a low rate in the low threes when rates were in the fives.
Becomes part of the advertising for the home. We have an assumable.
The way he sold the home otherwise.
We have an assumable rate on this home. Yep, absolutely.
But there are some challenges, and it's not an easy process. Give yourself some extra time. It's not like believe it, because you're dealing with government agencies.
Right.
And it's not going to happen as fast as you think. You might need a longer settlement than 30 days. Maybe a 45 or 60-day settlement is probably best to assume.
And as long as the seller is willing to accommodate that, that can be a really great solution.
So there are challenges, but it is a great program. Nothing easy and nothing worth going after is easy in this life, I suspect.
Absolutely. All right. Well,
let's wrap this up with you want to make the offer stand out, or we'd already hit that?
Actually, there are a couple of things that I would like to talk about. So we talked a little bit earlier about from my standpoint, the lender, how I can help you as a realtor make your offer stand out via electronic verification. The loan is done. I can remove, if I were to do that, electronically verify income, assets, and employment, and get an appraisal waiver, I would adjust my pre-approval letter, put all that on there, so that somebody could see that and say, oh, wow. Then the listing agent gets that pre-approval, and they see, oh, wow, all we have is an appraisal and some title work, and we're good.
It's as good as a cash offer, in my opinion.
Absolutely. And it makes a big difference. So that pre-approval, absolutely huge. There's also strengths of the offer based on the financing type, right? We talked a little bit more about that.
Conventional financing historically is always thought of as better than other things, because it's the funniest thing ever. I think it comes down to the
perception
It's a perception because of the appraisal process.
Yeah.
Two things that happen with government FHA specifically, and sometimes VA, are a little more stringent on the appraisal process. There's things they're looking for that they may
chipping
require
paint,
repairs.
Railings, any of those kinds of things that can present safety issues.
And the second thing with the FHA financing, if the house under appraises, they're very concerned with it sticking with the house. So an FHA appraisal that is done gets logged in to the website, FHA Connection, and it stays there with that property for at least 6 months.
6 months, yes, absolutely. So that can be a challenge, right? So type of financing can play a role there. There's some other strategies too, things that you can do to.
So if you were
help
making
your
an offer, somebody. So I would, if the reason the type of finance bears mentioning. So let's say I have a client who qualifies for both conventional and FHA financing. FHA, because they don't have the best credit score. They have decent credit, but not the best. It ends up being a slightly lower, less cash to close, or slightly lower monthly payment. But there's not a big difference between the two. If you were submitting an offer and it was the conventional financing that was needed to win the offer, we'd have that discussion with the client and say, hey, it's going to mean $15 more a month and maybe $1,000 more to close for one reason or another,
right,
to get this done.
But you win.
You'll win the house?
But you may win the house, right? And that's the conversation that you have with the buyer, and then you let the buyer decide. Correct. What is it worth to them, right? Absolutely. Mm-hmm. Okay. And then there's other strategies that can help you make your offer stand out, and we have a lot of, again, tools in our toolkit that can help give a buyer a little bit more of an edge. One of the things that you do is you try to cater to what the seller needs. And in those really competitive markets, we'd listen to them and reach out and find out.
Used to be something about writing letters, and I don't know if that happens much more.
Well, it's not allowed anymore.
Is that right?
So just so you know.
Interesting.
State of Maryland. I'm glad you brought that up, Michael, because it's a big issue, right? So the writing of letters is something that the state of Maryland has said, we're not going to condone this anymore because of fair housing laws. So,
I can see some of those writing letters.
Because you're writing things about, you can see your family with your kids, and so familial status is a protected class, right? Mm-hmm. Race is a protected class. There's a number of protected classes. We're not going to get into all of them right now, but the point is, it's a fair housing issue. And so the state of Maryland has come down and said, and many municipalities are thinking about this as well, but the state of Maryland has come down and said, nope, we're not going to do it. So in the listing agreement and in the buyer's representation agreement, it states clearly that you must understand that realtors cannot pass any letter along that you write.
I just thought of a specific instance where a letter wasn't written, but a client of mine won their offer because he was a veteran and the person selling the house was a veteran and he really wanted a veteran.
Well, and that can be obvious from the type of loan.
He can have it, but he can't state it.
Right? Well, it could be he's using a VA loan, and that may appeal to the seller, right? And those kinds of things can happen, and you can't control for it, right? But by and large,
it's not a strategy you should use.
Right. It's not a strategy that you should use.
Right.
Absolutely.
Well, I think we've given everybody out there some good ideas about how first-time home buyers can meet the challenges today of the higher interest rates and higher price values and a limited supply that's out there. Great information today. When we come back, we're going to talk a little bit about the unreal that's happened.
Absolutely.
Try it.
All right, welcome back to Be Real, the Maryland Real Estate Podcast. I'm Brad Cox with Investor Group of Long & Foster, and I'm joined by
Michael Becker of Sierra Pacific Mortgage.
All right, so Michael alluded to right before the break our segment, The Unreal, right? What?
It's unreal.
It's unreal. And this is an unreal situation. So there was an article posted in Fortune magazine, again by Lance Lampert. I am giving him lots of kudos today, but January 12th, 2023, about, I'll read you this sentence in the article, two sentences. On Wednesday, so prior to January 12th, on Wednesday, KB Home, they're a national home builder, announced that its buyer cancellation rate in the fourth quarter of 2022 spiked to 68%. That means that for every buyer contract that they had on a new construction home, 68% of them were canceling. Now, the article continues, that's up from 35% in the third quarter of 2022 and up from 13% in the fourth quarter of 2021. Historically speaking, it goes on to say, a 68% cancellation rate is off the charts.
Unheard of.
Unheard of, unreal. So the point, yeah. So it says even in the darkest days of the 2008 era crash, the average builder cancellation rate only reached 47%. So why is this happening, right? Home buyers were signing contracts with a home builder when rates were much, much lower, right? They were in the 3s and 4%. Get closer to settlement because there's a home construction process that can take 6 to 9 months. And we've already talked about this.
Yeah, there's only so long you can lock a loan. There's
Right.
extended locks. They cost money. You have to pay upfront fees. You take a higher rate. And a lot of people, especially after a long history of low interest rates, opted not to take
lock.
long-term.
Right.
But they were
Costs
wishing
money.
they did. But
And
didn't.
they sure do. Yeah. So they found themselves in a situation where they thought they were going to pay a much lower rate and then realized, oh, no, you're going to pay 6, 7%. And that difference helped them to not qualify for that loan anymore. Or they were also concerned about, okay, so now there's all this question mark in the market about what's going to happen with home prices. So are we going to be in a situation with falling home prices? And am I buying new construction,
Completely
which
reasonable by
typically,
somebody
right,
who's-
absolutely. So they're worried about that. And so there was pressure there. They call it pressurized affordability, right? So that run up and some of the concern about what might happen with prices just forced buyers to reconsider.
This is me 100% personal preference, but I'd be frightened to ever buy a new construction home. It's kind of like buying a car. The second you take it off the lot, it does tend to drop in value. You're paying a premium to have a brand new home.
Right. We always tell buyers. Well, we used to tell buyers when they. Well, we've lengthened the time right now, but we've always told buyers when you purchase a pre-existing home, plan to spend several years in the home. When it's a new construction home, you better spend 7 to 10 years. Now,
That's a good point.
over the course of the past few years, that dynamic did change a little bit because we saw so much appreciation.
Correct.
And yes, there may have been an immediate drop off, but appreciation came back pretty quickly. So it was a little bit less of a risk for a home buyer buying new construction.
So if you're going to buy and you're going to live in a house, for a while,
If you
maybe
know you're
buying
gonna
a new
be in
home
there
is not
for
a
a
bad
while.
idea. It is nice to have everything brand new, but you're dealing with the builder, you're dealing with delays. They hold all the. It seems like they hold all the power in the transaction.
They do. Now, there was a buyer that I worked with up in Aberdeen, bought into a new construction home. But this is why, as I mentioned to you, it wasn't as bad in the past couple of years. He bought with every intention of living in that home for 7, 10, 20 years. He had no plans to move. He got relocated by his company, so he bought new construction, had to sell the next year. Now, because of the appreciation that occurred, it was pretty significant appreciation, and we were able to get him a price with the right marketing and positioning that was significantly higher than what he normally would have gotten, and he wound up ahead. But it's very often the case that if you have to sell quickly and that home price isn't what you paid for when you bought that home, you may be coming out of pocket at the settlement table to satisfy your existing loan.
Either that or become an unwanted landlord, renting out a house over time.
Absolutely, absolutely. So
That is unreal to drop in that. That's amazing that those numbers drop more than during the housing bubble. While you were discussing that, I went up. When was the data that?
January 12th was the article.
Interesting, because I looked at the stock of KB Homes, and it's actually rallied a good bit from its lows, but the 9th to the 11th, which might have been when that report came out, they dropped about 10%.
That's telling. Yeah, absolutely, absolutely.
Just share price.
All right.
publicly
All right.
traded.
So we're going to roll right into our next segment, which is the spotlight,
Okay,
right?
who we spotlighting this week,
So,
Brad?
yeah. So one of our intentions with this podcast is we want to support local businesses. And there's a local business that we do a lot of business with because Michael and I are part of a networking group. So we regularly meet at this location, and then I use this location personally and professionally
I
for
love
business
going there.
meetings. Yeah, it's a great location. Is Michael's Cafe on York Road in Timonium, right? Just north of Timonium Road.
Correct.
And they just recently did a
Nice rehab.
really nice rehab of the dining room, and it is beautiful in there. So we get great service. Food is always great. They have some of the area's best crab cakes. So we really like Michael's Cafe. Wanted to give them a shout out
Sure.
in this episode. So if you get a chance, give them a holler, set up a reservation, go in there and check it out.
You won't be disappointed, I can promise you that.
Absolutely. All right.
All right, let's wrap this up for this week. I'm not sure what we're going to talk about next week, but we'll come up with a great idea. Do you have any ideas off the top of your head? I don't want to put you under pressure, Brad.
Oh, well, we've got
got
many ideas.
Right. But this was a very important topic to get out there. In fact, we may even expand on the first-time home buyer because although we touched a lot of topics, I'm not sure we've completed it in total. But we'll be back next week with another one. As I said, I'm Michael Becker, Sierra Pacific Mortgage.
And I'm Brad Cox with the Vesta Group of Long and
If
Foster.
you'd like to reach me,
Yeah, how do you reach me? How do you reach?
Michael Becker,
How do people reach you, Michael, if
can
they want to
email
talk
me.
about mortgages?
they can always call me on my cell phone, 443-310-0012. My email address is fairly easy to remember. It's my name, Michael.Becker, at S as in Sierra, P as in Pacific, M as in Mortgage, C as in Company.com, SPMC.com.
Beautiful. Thank you, Michael. And if you need to reach me to talk about anything with regard to your real estate plans, you can reach me via email at brad@homesbyvesta.com.
Say that one more time.
homesbyvesta.com. brad@homesbyvesta.com. And my cell phone is 410-375-7550.
Thanks so much for listening. We'll talk to you next week.
Take care, folks.
Drop it.